Hello, this is Philip at Laptop Trader Channel on YouTube. Welcome back to our stock trading and investing community. What is required to trade stocks or other securities? Well, you need some money or some capital to trade with. You're going to need some sort of computer or laptop, just a basic model. You probably only need one monitor. You're going to need an internet connection, most likely a high-speed or broadband connection. You're going to have to choose which online broker you wish to use. There's so many to choose from now that are low cost and user-friendly. I just listed a few here, including TradeStation, Interactive Brokers, E-Trade, Schwab, etc. You're going to have a budget for personal and your trading budget. If you can't do this, I don't recommend you trade because it shows you don't have any financial discipline, but you're going to need some money to trade with, so you're going to need a budget for trading. You're going to need some sort of trading plan with some goals for your year to break down to a weekly or a monthly goal. So if you had so much capital, and let's say you want to make $1,200 this year from your trading, well, you would need to make on average $100 per month profit to meet your goal. So just set some sort of goal that is within your means. You're going to need some money management, risk management, and some trade management limits. We'll talk about that every month. You're going to have to do some homework. You're going to have to know what are the rules of the market. You're going to need to come up with in your plan, what does my ideal trade or investment look like? What price range of stocks is comfortable for me? So, would that be stocks under $500 or stocks under $100? When I first started trading, I became very comfortable with stocks under $25 to start. So you just need to pick an area where you're comfortable with, and that's up to you. You're going to need some way or an approach to gather and select information to narrow down your list of companies to invest in or to trade. So there's over 8,000 individual stock, and you're going to need a way to narrow that down. Again, some sort of information sources and charting resources you are comfortable with. In my opinion and understanding of the 4 market stages, you're going to need a system to track your progress, whether that's on paper or on a spreadsheet or on some sort of note-taking software, but you need to keep track of what you're doing. Otherwise, things can get out of control. But these are required before you ever push the button on your first investment or trade. So let's get prepared. Again, this is just another list I put up quickly. I'll read through it. Some capital to trade with. What's your level of trading or investing experience? Be honest with yourself. 0 would be somebody new. 10 would be a seasoned professional. What time of day can you trade? That's important because if you have a full-time job, you have to work around that. You're not going to be able to trade at your job, most likely. How much time can you commit to trading? I generally commit between 3 to 5 hours per week. If you have a spouse, is your spouse on board? Because they need to be. They don't need to know everything, but they definitely need to know how much are you going to risk. What risks are you taking? Why are you taking these risks? And just discuss it with your spouse. Be honest, because money's an important thing. What dollar amount would you be willing to lose in any one day or any one trade? Okay, so you're going to have losses. You need to come up with an amount that you are willing to lose. What dollar amount lost would cause you to lose sleep? So I personally use position sizing to deal with that issue. I keep my positions to a level that if that stock went to 0 tomorrow, it would not affect my life. What's your general risk tolerance? This will change over time with experience, but the ratios will not. Okay, so start small. Really start small if you're new, like $10 per trade, and use share sizing to accomplish that. So just come up with what is your maximum position size and what are your loss limits. So I generally use, and this is just a rule of thumb, but I use about 10% of my account size for my position size. Others that are way more experienced, they may use 50 or 100%. They just may go all in on a stock because they've seen that set up 100 times. But for me, I'm comfortable with 10%. If you're new, maybe you want to start really small, right? Maybe only take a 1 or 2% position size and then use share sizing to even reduce your risk even further. Again, what price range of stocks are you comfortable with? Are you planning on holding stocks overnight or over a weekend or through earnings events, which can be very volatile? Again, set some goals. Are your goals reasonable, right? Divide that goal by 52 weeks. And that, excuse me, that's what you would have for, a weekly goal. What does an ideal trade or investment look like? That took me a little bit of time for me to figure out. Are you going to use technical and or fundamental information to come up with that ideal trade or investment? And then figure out, what is your personality like? Are you impatient? Do you get angry easily? Are you happy? Are you a gambler? Do you hate to lose, or do you love to win? Do you like new challenges? Are you analytical? Are you more emotional? And finally, I'll share with you, this business, you are really trading against yourself, okay? You have to control your emotions, and you have to control, you really have to be really cold-hearted towards this business. Anyway, let's get on with a few more items. I look at Wall Street as, Wall Street rings the bell in the mornings and when introducing new companies to the market. I look at the pricing cycle as the shape of a bell. So this is just basic stage analysis. You've got stage 1 on the left, where you have kind of a stage of indifference or consolidation where price is flat. Then we have stage 2, which is a stage of greed. You can clearly see prices moving up. There's an uptrend, and you can see buying taking place. And then we have stage 3, which can be another flat area or a plateau or a peak. Again, it'll look like many times a consolidation. And then from there, you can either have a continuation of stage 2 higher, or prices can reverse and go down, and we can start a downtrend. Where stage 4, which is generally considered the stage of fear, where you can see pretty clear signs of selling during that stage and prices decreasing. And then after that, either the cycle starts over, or the company and or product or service goes out of business or goes away. So that's just how I look at the market. Again, this is just some different names for these stages, and I'll love to just kind of sit there for a few minutes. But I use music as an example, and if you look down at the bottom of stage 1, you can see maybe there would be a new service or product in the music industry. And then in stage 2, we can see where a new service would become more popular, right? Like MP3 or podcasts or streaming music, okay? And then stage 3, when everybody is listening to radio or live concerts, and maybe sometimes that plateaus and people stop listening to the radio, or people stop going to the opera, or people stop going to live concerts because it's free online and you can just stream the concert, okay? And then from there, as products or services fall out of favor and become less popular, we can see that stuff that has gone away or is certainly not popular anymore, like records, tapes, CDs, phonographs, right? So those are products and services in the music industry that are no longer as popular or even available. And then again, the cycle will start over, or that product or service simply goes away because of changes in the market or changes in technology. So I think that's a real easy way to look at the 4 stages by using music as an example. Again, this is what it would look like reversed if a product or service or company was sold off for whatever reason and then went into a stage 1 and then resumed a stage 2 again. This would just be a simple line chart with an overlay of an average market price. The green line would be more of an average price. Then we have just a basic line chart which shows the repeating pattern and money flowing in and out of a market. So that's all we're looking at, okay? We're just looking at money flowing in and out of a market based on wants and needs and based on what's popular now and what was popular back then. Okay, so it's very easy to see in visual form on a chart. So the next thing I look for is an advantageous entry point into a position. So after we identify what stage we're in for any security we wish to trade, we need to decide when to enter that position, when to push the button. This is an ongoing process and gets easier with experience. So for my trading plan, I like to enter in late stage 1 or early stage 2, and preferably during a consolidation in price or a retracement in price with a buy setup. I do this because I'm looking for price appreciation. In Wall Street terms, I like to buy and go long. I am also buying at a certain point to try and maximize my risk to reward. A consolidation or a tighter price range can give me a better risk to reward using my strategy. Again, this is an ongoing practice, so we cover this monthly. So here is an example of the price stages. This is Zoom Video Communications, Zoom, symbol ZM. This is a monthly chart, and this clearly shows stage 1, stage 2, stage 3, where that plateaued, and then stage 4 where Zoom was sold off, and it's been in stage 1 pretty much ever since. Okay, so that's just kind of what the different stages look like on a real price chart using real price candles. Okay, that's a candlestick chart, not a line chart. So I think that's pretty clear to see. This is an example of an advantageous entry. So this is Chewy Company, right? The popular online pet supply retailer, symbol CHWY. And if you just read through this area, price was in a downtrend, and then it transitions to a bottom down here. So you can see prices moving down. That kind of transitioned and went up. Notice how at the bottom, price here is back and forth, okay? And candles are larger. Can you see the size of these candles from the top to the bottom of the candle? They look like they're large candles, right? And notice where I entered after price consolidated and the candles got smaller. Price tightened up right in here. So all of a sudden price went up and then just kind of started going sideways, consolidated, and you can see this price candles or price bars got smaller. This gave me a good risk to reward trade entry right here on this day. Because the candles were smaller, my stop loss was smaller, therefore my potential reward was greater. So the way that really works is instead of down here, like let's say I bought down here, instead of taking a $5 per share risk, I bought up here in this area and I took a $1 per share risk, therefore allowing me to buy more shares using a stop loss strategy. So in this example, if I was a new trader and I took $1 per share risk, right, I could buy 10 shares if I only wanted to risk $10, or I could buy 20 shares if I wanted to risk $20. If I'm a big shot, I could buy 1,000 shares and risk $1,000. But if I had bought down here, right, I could only risk, if I was only going to risk $10, I could only buy 2 shares because of the size of the candles. Make sense? Good. Easy. This is just a basic drawing I made of how to read a pricing candle or a pricing bar. It's very easy to read. You just have a high price and a low price. You've got the range, right, which that's the range of the candle. And then you've got the close and the open, which is opposite between green and red candles. You got the body of the candle. And then you've got these wicks or tails, which is that line on either side of the candle. So I'll leave that there for a few seconds and you can look over that. And then I just want to give you guys some examples of some information sources. So this would just be a quick Google search. I went to Google Finance. I typed in the symbol for RingCentral, the popular doorbell company, symbol RNG. And this is what, so just some basic information comes up from Google Finance. You get a free chart. You get some basic information to the right. If you scroll down the page, you probably get more information from Google. And then you could go and do some homework from there. Okay, so this is the same company, RingCentral, but on a different platform. This is on barchart.com. So it's just the same information, basically. It's just laid out a little bit different, and it just depends on what you prefer. So there you can see the name of the company, the price, you can see some basic fundamental information, and you can see a real quick 1 year chart of RingCentral. Here will be, again, the same company, on a different platform called Seeking Alpha. This has different tabs like summaries and ratings and earnings. Again, it comes with just a basic chart and some basic fundamental information to the right and some different grades that they use to judge companies. Here will be another one. This is from stockcharts.com, showing, again, the RingCentral, showing a basic candlestick chart. This one is using what's called clear candles or hollow candles and red candles. So you can change the color of those candles to whatever you want. And at the bottom, they're showing an indicator called the MACD indicator. So that's just showing that. So it's a fine service, but it's just a little bit different look. FinViz is another service. Again, it shows a chart, a symbol for the company. If you were to scroll down that page, you'd see some basic financial information on the company. But again, it's just a price chart. A little bit different layout, and again, that's another fine service. This would be RingCentral using investors.com, a very popular service. They charge for their service so much per month, but it's a very popular, well-known service started by William O'Neill, who's famous in the stock community. So the information will just be presented in a different way. This would be again, the same company, but a different view on tradingview.com, another fairly popular service with, like live charts. You can get earnings and revenue right there on the chart. If you hover over and click on the E symbol at the bottom of the chart, this chart's just showing price and volume, symbol, and some basic information on the company. So any of these services I believe, have a free option. All of them have a paid option, so you can get rid of ads and so you can save different chart lists and stuff like that. But that's up to you to review. I generally have used Stock Charts, FinViz, and BarChart.com. I find those pretty friendly to use. TradingView is also friendly, but they're all have the same information, just in a different format. So you just have to figure out what you prefer. And finally, this would be from my broker. So this is, again, RingCentral with the price. Again, so shows some basic volume and fundamental information and a small chart to the right. So you can even just use your broker if you want to use charts from your broker too. Anyway, I'm going to end this video with some helpful suggestions for success in trading. I would suggest not making any new major purchases such as cars, appliances, homes, and furniture, as those are depreciating assets. I would say don't go into any new debt and or pay off your debts, and use some financial discipline so you have some money to trade with. So if we get our finances in order and we control our money, we can use money management. Keep some cash in our pocket for an emergency. Be prepared to have winning and losing trades. It's very common for even professional traders to have, a 40 or 50 or 60% win rate, meaning they lose 60 to 40% of their trades and are still successful. By using position sizing, we can control our risk exposure and not blow up our account. By using share sizing, we can set our stop limits, and we can take the risk per share times the number of shares we risk times the number of shares we wish to risk. So that can be anything. That can be $5, $10, that could be $1 million. It's up to you and what you can handle. Use money management and trade management and risk management to your benefit. Become financially educated and understand the markets and the economy for yourself. Be aware of how other factors affect stocks, such as interest rates and economic policies. Don't live in fear and ignorance. Get informed and educated, and be confident in your skills and create your own economy for yourself. Finally, know your position. I talk about this a lot. You're essentially trading against yourself. It's your skills versus your fears and your experience in the markets. That's what I found out. Anyway, thanks for watching this introduction to the Laptop Trader channel on YouTube. We will see you in the next video. Good luck, Phil.